For most founders, scaling a successful game or app portfolio comes with a painful trade-off. Either you raise more equity to fuel growth and give away a permanent slice of your company just when you found that elusive product market fit, or you slow down, reduce your UA spend, and watch competitors catch up. Now, user acquisition financing breaks that stalemate. By funding the predictable, measurable engine that turns $1 into $3, if your user acquisition is functioning correctly, it lets you scale proven titles. You can launch new ones, expand your portfolio without handing over more of your cap table. Now, personally, I've never used UA financing myself. I don't think we had the right instruments at that time. But there are companies today like Superplay who scaled into billion-dollar exit who did use UA financing. This podcast is a deep dive into UA financing with the best in the business, General Catalyst and PVX Partners. All right, welcome everybody to the Deconstructor of Fun podcast. I'm your host, Mishka Katkoff, and today I got two guests, one with a very difficult last name and one with much easier. So let's start with the OG returning guest, Joe Wadakethalakal, CEO and co-founder of PVX Partners. Welcome back to the podcast.
Thank you, Mishka. Great to be here. Looking forward to the discussion today.
Yeah, and dialing in from the beautiful city of Singapore. I can see it on the background, right?
Yeah. Late at night.
And then onto the second guest from not as beautiful city, San Francisco.
Hey, it's getting more beautiful. It's getting more beautiful.
Yeah. I was there in March. Pranav Singhvi is joining the podcast. So Pranav is co-founder and managing director of Customer Value Fund at General Catalyst, and it's a customer acquisition financing. Pranav, tell me a little bit about what you do, why you do it, and why do you work with PVX Partners?
Yeah, absolutely. There's a lot of questions in there, so I'll just get started with a bit of the background and history, and then if I miss any of them, just feel free to ask me as well. So I've been at General Catalyst now almost 6.5 years, coming on 7. And co-founded this fund based on a pretty simple insight that I gleaned when I was at my last company. Prior to this, I was at a company called Palantir Technologies, where I spent 5 years as well. And the core insight behind what led to the Customer Value Fund was on the simple observation that if you look at technology companies, once they reach a certain size and scale, their main use of capital is to constantly invest it in sales and marketing, some form of customer acquisition cost. Different companies call it different things. In the B2B SaaS world, you just call it go-to-market or sales and marketing. In the gaming world, you call it UA. D2C brands just call it CAC or customer acquisition cost. But ultimately what you're doing is you've reached a certain size and scale, you have product market fit, and your main use of capital is to pour more fuel on the fire, which is investing more dollars in some form of sales and marketing to generate a fairly structured rate of return in the form of lifetime value. Now, the thing that I found really, really bizarre is technology companies at large, once they found product market fit, they were using the way they were financing this activity was predominantly using their own balance sheet, which is their own cash, which is largely equity capital, often equity capital that they've raised historically over the multiple rounds and alphabet game that you tend to see technology companies play. And it was really bizarre because you're giving up your company forever to acquire a customer once that pays you 2 to 3 times your money based on your lifetime value unit economics. That doesn't sound like a very good economic trade. And it was always confounding to me that this is actually the way that most of these companies finance their growth. And so the big question originally was, why are companies engaging in this uneconomical activity? We spent a lot of time initially with many of our founders here at General Catalyst and otherwise as well, asking them the question, hey, we all agree that this is an uneconomic trade. Why are you engaging in this activity? And when you double click into the problem, you actually realize there's a very rational reason for that. And the very rational reason is, well, if you think about the alternatives, whether it's traditional corporate debt in the form of a revolving credit line, a term loan, or any other variation of traditional products that exist, the issue with those products is if you raise those forms of capital and invest it in growth, the payback on your debt and the payback on your sales and marketing are completely misaligned. They have nothing to do with each other. And in essence, if you raise debt to invest in growth, at some point, invariably, the payback on your CAC is going to be outside the maturity window of your debt. So you'll have to pay your debt back ahead of when you pay back on your CAC. And that encumbers the company with a ton of risk. It adds a ton of risk to the company's balance sheet and downside. In fact, the better you do, the more risk you're adding, because the better you're doing, the more you want to spend on growth, often extending paybacks even further, adding risk even more. So this is actually the rational reason why companies don't use traditional debt at scale. It doesn't mean companies don't use debt at all. However, they don't use it at scale to fund growth. And that is what made the light bulb go off in my mind, where I said, well, gosh, this is a very well-known problem in finance. The finance word for it is an asset liability mismatch. You have a liability that has to be paid back in a manner that has nothing to do with the cohort of customers you're acquiring. And so this problem, we got inspired by other solutions that have existed in not the tech world, outside of the tech world, where you go to a company and say, we will finance your ongoing growth, your sales and marketing specifically, and get paid back just from the lifetime value of the cohorts of customers created from what we funded until we hit a target return multiple. Once we're done, the full lifetime value accrues back to the company. But if it doesn't work, we own the full downside risk. And this is very important. There is no mismatch with this product, which is if we go to a company and we fund their growth, we own the full risk in the event that investment in growth doesn't work out. So that's basically in a nutshell what got us going. We've scaled up quite a bit. This is a separate fund within General Catalyst. We manage about 10 figures in AUM. We're deploying about 9 figures per month across 50-ish companies. And that's a bit of the history behind how this all came about to be.
So Joe, tell me a little bit about PVX Partners, because what Pranav is explaining sounds like PVX Partners on steroids. PVX Partners on steroids, right?
Yeah. So great question. So look, we're doing something similar, but I would say our scope is very different. Whereas, General Catalyst is a fund management business, right? They're purely in the fund management game, where we're structured more like a company. And so, we have lending as part of our business, and we work very closely with Pranav and the CVF fund, with our balance sheet together to make those loans. But where I think, and Pranav, correct me if I'm wrong, but Pranav's focused on anything that has LTV, like any business that has good LTV and using CAC against it, he's able to fund that. Whereas we are very focused on mobile gaming, and I think also consumer apps, but just generally given our background, my background, and the background of most of our team, we're all, ex-gaming operators, really. So mobile gaming is our core focus, but more importantly, we're actually trying to also use the insights that we get in aggregate to deliver a lot more than just financing, right? So our kind of bigger picture is that we think the current publisher stack for most mobile gaming companies it doesn't really work. We don't think the economics work for the best studios out there. If you go with a traditional mobile gaming publisher, the economics are not that attractive. And so one way to think about PVX is, at the same time, those publishers do provide a lot of value, right? They provided financing, they provided product enhancements, they provided marketing optimization, but it was always in one package. So what we're trying to do at PVX is disaggregate that and make it a buffet, right? So, hey, if you just need the financing piece, we can work on that. If you don't want the financing piece, but you want UA optimization, we'll give you that. We don't do this right now, but eventually, if you want product advice or product optimizations, we can deliver that as well, right? And so we can put all these together, or we can offer them a la carte. But that's really what we're trying to build out, right? It's not just we're not just a financing business, and we're much more, I guess, focused on a specific category.
Today's podcast is brought to you by AppsFlyer, inviting you to dive into their new first of its kind report, The State of Creative Optimization 2025 edition. It's not about how to make creatives. It's about understanding what makes users actually stop scrolling and what emotional and psychological triggers drive performance. Based on over 1 million creative variations and nearly $2.5 billion in ad spend, the insights in the report will help you develop a winning creative strategy. Check out the link in the podcast description below, or go to appsflyer.com and search The State of Creative Optimization. That's appsflyer.com. You've heard of heroic labs by now, and we keep talking about them because you need every edge to be successful in today's market. Heroic Labs game stack is built like a brick house. You got the Nakama, their backend game server, Hero, their game development framework, Satori, their live op service, and last but not least, Heroic Cloud to provide massive scalability. Heroic Labs is a battle-tested partner, and their tech enables you to be flexible, creative, and scale for success. Focus on your game, avoid tech risks, grow your product with scalable live ops, and save a big chunk of cheese, all with Heroic Labs. Yeah, so
the story with how we met is, sorry, go ahead.
Yeah. I'll just summarize like the differences between the two of you, and then let's talk about how you guys met. Because
that's a good story.
We worked we worked with PVX on one of the company that was consulting, and if I understand correctly, like when we worked with PVX, you guys came up with such a great analysis that really allowed the company to understand what they need to do on the UA front to improve it in order to be eligible to get PVX's financing at the same time you're willing to fund their other portfolios. So you did a real deep dive into their UA and into their operations that was quite actionable, actually really actionable. And then Pranav, on your side, you're operating at scale. So you're basically just looking at companies that are already deploying capital and they're looking to deploy more. And instead of them going to the VC route or the debt route, you're able to give them a lot of capital, like tens of millions, in order to scale their customer acquisition and hit the hyper growth. Correct?
That's pretty much an accurate summary. And look, the fundamental underwriting infrastructure is required regardless. The kinds of scale of companies we typically tend to work with are much more focused and have a sense for how to go acquire their customers and then how to retain them over time. And so our focus is really about scale and scaling the companies that are already at somewhat of a scale, but really want to get to the next level.
Mm-hmm. And so, let's go back to how did you guys met? Like, how come you're working together?
Yeah. So this is a fun story, and Joe, you should fill in the pieces that I don't remember perfectly. Yeah, exactly.
I'll give you my take.
So interestingly, I met Joe when he was a potential customer. So this was now 3 years ago. I forget exactly when, but
about 4 years ago.
Maybe like 4 years ago.
2021, 2022, that sort of time frame.
Yeah, and Joe's prior company, which was at MPL, I had basically talked to Joe about potentially doing a deal with MPL, and we had talked through what it would look like. We actually, did a lot of back and forth, and I think Joe had went in pretty deep and how this actually worked and truly understood it. And it's pretty rare how much depth of work that he did when we were going back and forth on it, just given his understanding of finance as well, which was honestly great. We typically really appreciate that. And I think that specific deal for a variety of reasons did not pan out. However, I think we both developed a great relationship through that journey. And it was one of those things that I don't know, Joe, if you felt this, but I definitely felt this, that I knew we were going to work together at some point. I didn't know how, what, or why, but like, it was very clear to me that we had built enough of a relationship that at some point there's going to be some opportunity to work together. And then I think when Joe decided to transition from MPL and was thinking about what is next, we were talking about ways of potentially working together. And one thing led to another. And I think what Joe had laid out to us was like, look, I think there's a very interesting opportunity with what you're doing focused on mobile gaming, especially for companies that are, call it, sub 2 million a month of spend. There's a massive category and opportunity there, which in reality today for us would be probably on the smaller end and would just not make sense for us to engage with. Typically, we work with companies that are above that. And we talked through what working together could look like. And so we said, look, that makes a ton of sense. The analogy that I often use is, while PVX is not technically a publisher, we kind of think of them as like a holding company of apps that we provide a dedicated balance sheet to. And like Joe pointed out, on the PVX side, they used our balance sheet to provide the financing to the underlying companies, in addition to a lot of the other insights and product work that they do to help that specific category of companies, which ends up being a very, very synergistic relationship. But that's kind of the background and the history, Joe.
Yeah, I mean, look, I think I don't know if I've ever told you this actually directly, Pranav, but so the first time I heard about this, um, I just I couldn't believe that it existed, right? The idea of someone actually taking the downside risk on our cohorts,
Cohorts. Yeah.
And this was me with the MPL hat on and sort of thinking as a capital allocator there. It just blew my mind, right? Because there have been revenue-based financing folks in the market before. And to give you a bit of context, before we actually talked to um, Pranav, we had talked to another player. I don't even remember who it was, but they're doing traditional revenue-based financing. And this was like, okay, hey, we're going to take a rev share on your UA, but if it doesn't work out, you're going to have to owe us the money anyway, and we're going to take a full security pledge over your entire company. And so I was just like, this didn't make any sense because it was just too risky. Because at MPL we were basically a business that was all about spending on UA, right? Like, because real money cohorts last forever. As Mishka, I don't know if you know, but Pranav and I for sure know this, right? Real money cohorts are beautiful cohorts. They
They are.
last forever. And so you're really in the game of trying to spend as much as you can on UA as long as you're meeting a certain threshold. And I remember telling my team, this is such a no-brainer because Pranav is taking an asymmetric bet in the wrong direction. And so we should just do this all day. Um, and 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 yeah, so I think I actually understood it immediately. Um, or maybe not immediately, but once I got it, it became immediately apparent to me that this was just the future. And I started to build so much conviction around it. And actually, it was throughout my time at MPL, I was always thinking like, oh, this would be such an interesting. If I wasn't doing MPL, I would love to work with Pranav and like do something like this, right? And so, as I was trying to, coming up with, as I was deciding to kind of move on and trying new things, it was very like I just had a lot of conviction. And as an entrepreneur, it's actually rare, I think, to have that kind of conviction early. But I knew just from being in the market that this was a product that the market really needed. And there was also space for someone to be very, very focused, because you are having different conversations with gaming founders. They're actually very, very sophisticated with respect to UA. They all understand that that is the lifeblood of their business, and so it's a different kind of conversation. Um, and so I thought there was a lot of value in being very focused on that space.
Mm. I wanted to ask you, so Pranav, General Catalyst is a VC fund and it's also private equity at the same time, kind of? No?
It's a venture capital fund, and General Catalyst has been around for 25 years. Started out in early stage venture capital, over time scaled with the founders that it had invested in, and does a lot of growth stage investing. We also have a creation fund where we actually invest in companies to buy companies as well. That's a lot of that is driven by a lot of the transformation that's happening via AI now, especially in specific categories that lend themselves really well to LLMs. And you can think of General Catalyst as a family of funds that really is in the business of trying to figure out solutions for founders as it relates to capital. And so in some sense, like pretty much anything General Catalyst does is just in the service of solving a problem for a founder. And that's part of the reason we're at General Catalyst, me and my co-founder, KV, is because Hemant, who's the guy who runs General Catalyst, has that problem-solving mindset, that builder mindset of really building solutions for founders at scale.
I wanted to ask that point of view from General Catalyst, because how should founders think about if the VCs want to offer them capital to scale? Is that of course that's a good sign. That means your business is doing really well. But should you think about twice and maybe go through UA financing or customer acquisition financing route rather than equity, or maybe a combination of both? Like, what's the thinking behind that? Because I'm just giving an example. Oftentimes you get to Series A when you need to scale your company, your product, and that's when you're going for that $10 to $20 million round if you are running a gaming startup. And majority of that will be used essentially to launch the game into global markets after test marketing. So what's your take, kind of being on both on the VC side and UA financing side of things?
So look, ultimately, the way to think about this is just aligning your sources of capital with your uses of capital, right? All these products have different sources, and they have different risk spectrums and different costs associated with it. And similarly, the way you use it, you use them in different ways. So my view is, look, if you're launching a product like there's basically no historical data, and you just need to build something and there's no historical data associated with it, equity is the fundamentally right product for it. That could be in the context of a completely new company. It could be in the context of an existing company that is building new product lines, new geographies, or acquiring maybe an entirely new business line. When risk is unstructured in nature, equity is the perfect capital for that, right? At some point in your life cycle as a business, parts of your business are become a lot more consistent and predictable in nature. You spend $1, it turns into something more than $1, and it's highly underwritable. That's when it makes sense to actually think about other sources of capital, something like the Customer Value Fund or PVX, is when you feel like you're at the point where a part of your business has that level of structure, and it makes sense for somebody to come and finance that for you. So ultimately, the goal isn't whether you should not use venture capital at all or use something else the entire time. It's actually just about thinking through how are you going to structure your capital in a way where the sources and uses are completely aligned. And basically, if the example you gave, if somebody's raising a $20 million round, well, maybe 5 or 7 of that is for product investments, and maybe the remaining 10 or 15 is for customer acquisition cost. Well, maybe for the 10 to 15, you should actually use a different source of capital. And for the 5, you should still go raise that equity. And you can sort of decide what is the appropriate levels across the board. And so your capital structure should just reflect what your plan is of how you want to use the capital. Is just kind of how we think about it for our companies.
Yeah, and I would just add that, I think ultimately, as a CEO of a company, whether you are aware of it or not, your job is capital allocation, right? That is your job, and I think obviously as you become a huge company, if you talk to CEOs of really large multi-billion-dollar companies, they understand that they're ultimately capital allocators. But the reality is, even when you're a early stage startup, the most important job is capital allocation, and that's all about saying, how can I get the cheapest cost of capital for my business over its lifetime that also carries the least amount of risk, right? And so that's the way to think about it. And that doesn't mean, like, there is a place for equity. There are other benefits for to doing an equity round. I as a former operator myself, I would say, there are other reasons beyond just capital of why you might want to do a round, whether that's tied to things like hiring, having a certain mark on your assets, because people like to kind of feel wealthier, and people like to feel kind of their value in that startup increase. There are other reasons, but that doesn't mean that if you have $100 million capital need, you should fill it all with equity, right? I think, and we see, actually, when we talk to companies, we're speaking to a lot of second time founders. We see a lot of interest in this type of instrument, from people who have, this is not their first rodeo, it's sort of their second company, and they are much more cognizant of the real cost of equity capital, because they've sold their companies and they've seen how much they've given up, and what that's cost them.
That's a very valid point. Like, I wouldn't have thought about this if I wouldn't have the experience that I do now. And the way I'm thinking about UA financing, correct me if I'm wrong. If I'm able to get UA financing, I'm trying to get to a stage where my cohorts are predictable. I'm getting the UA financing. What I could do with that is I can scale the product with it. At the same time, my return is not as good because I have to pay, typically it's 50% of everything that you earn on top of on the cohort that has been paid with UA financing. So let's say you invest 100K, it comes back at 120K in, let's say, 6 months. I'm getting 10K from that, and 10K goes to the financier, right?
I think it would be a lot lower than that. It would be a lot
Yeah,
lower than that, is my sense.
yeah, it's a lot lower than that, and actually returns look a lot better. So
Okay.
and Pranav, jump in if you have a different view, but at least from the PVX perspective, right? We're looking at companies like Pranav said, generally spending less than 2 million a month in UA. And there are many of these businesses out there. And if you're, currently at a stage where, let's say, you're spending $1 million a month, the companies that we're looking at are really hungry to spend more, right? They're saying, hey, I'm spending $1 million. I'm like pushing my balance sheet as much as I can. I really want to get to 2 million in 6 months, but I can't right now. It's going to take me 18 months to do that. And so we don't come in and say, great, we're going to take over 80% of what you're already spending, right? We may do that we may take over some of their spend, but generally the capital we're providing is incremental. And so if you think about it, they're spending the same amount, but getting a much higher return, because once we meet our hurdle, then all of that upside goes back to them on the back of what they were initially spending. They're not having to ramp up their spends at all. So their effective return on their ad spend can 3x, for really good cohorts.
With no downside risk.
And with no downside risk, which is
which is
the thing that really matters, right? Generally for us, if we look at a company that says, hey, we're spending 1.5, but we can't really grow, and we want you to come in and fund 80% of it, that's not really exciting for us, because generally those aren't companies that can scale. I mean, by definition, they can't scale if they're only asking us to leverage their existing capital, and so, or their existing spends, and so we can't invest as much, if that makes sense, right? So we are really focused on the companies that are growing, that are scaling up, and are looking for the right capital partner, where if for whatever reason that doesn't work out, we're going to share that downside risk with them, right? But if it does work out, it's incredibly high return.
Add to that further, Mishka, if you take a look at, this is very true in gaming, it's true in broader across the entire technology ecosystem, is the level of spend you can have on your growth, UA in this case, has always been a function of how much balance sheet you can accrue, like how much equity capital you can go raise. Because really, the decisions made around what is the appropriate level of spend is not a function of what is the appropriate level of spend based on a marginal CAC to marginal LTV equation, which is really how you should be driving your business. It's actually driven more based on how much cash I have on my balance sheet. And even though I can spend $1 and get back $3, I don't want to triple my spend because I'll bankrupt my company purely because of the cash flow gap between CAC and LTV. The whole point of this product is to decouple that decision. You want to decouple the decision to think about what is the appropriate level of spend on growth from a balance sheet constraint. And the reason that is very important is along what Joe said, which is the entire set of decisions you make completely changes. There's an entirely new dimension in the way you can build a business. To give you a very tactical example of this, in the gaming world, as I understand it, typically it's said you should not have paybacks longer than 12 to 15 months or something like that, right? Let's just use that as a heuristic. Well, why? Who made up that number? What if you have cohorts that have long lifetime values? Why not have 24-month paybacks? Why not have 36-month paybacks? If the lifetime value supports it, shouldn't the payback be an output of the fact that you should be spending until your marginal CAC equals marginal LTV, which is marginal cost equals marginal revenue, which is how you maximize the enterprise value of a company? And the reason nobody even thinks in that dimension is because the constraint is the balance sheet, which is I'll go bankrupt if my paybacks are longer than 12 to 15 months, even if the ROI is fantastic. Right? The ROI could be very good at a 24-month payback because you have the lifetime value to support it, but you can't do it. And that is very, very important. And this completely changes the value of a company, because all of a sudden, when your mindset is what is the appropriate level of spend to optimize for the enterprise value maximization function versus a balance sheet constraint mechanism, you just build significantly bigger businesses. And I think this is even more acute in gaming than any other category that we work with. But it is something that completely changes the value of a company over time.
And so basically what you guys are offering is something that only more mature companies or or well-off companies can do, and that is pushing back your payback times.
It's ultimately you have data to support the fact that you can spend more on growth.
Yeah.
Whether that is, there are companies that have a ton of data at $1 million a month, right? That for instance, PVX partners with, and those make a ton of sense. For us, purely from an overall business standpoint, it makes sense to engage with companies that are spending at least, say, call it $2 million a month. And so that, putting that part aside, the question is not the level of spend as much as it's also about, like, do you have the data to support the ability to grow your spend? And a lot of companies that are spending at $1 million a month, they could be spending a lot more, but they today don't, purely because of the balance sheet constraint that I spoke about earlier. Their unit economics totally support it. So in short, yes, the company needs historical data, but the size of the company will be a function of how much capital they've raised, right?
Yeah.
Yeah.
And when, yeah, I just wanted to kind of like get into like, when is the right time to use it? Like, of course, I understand Pranav works with scale ups essentially that are going to be even bigger. But like, Joe, how early can PVX jump in? Because I understand you need to have a data.
Yeah. So generally, if a company is spending less than 200-300K a month, they're generally a little too small for us. And the reason for that is, we've seen companies that, we've looked at companies who've asked us to evaluate them that are spending like 50K or 100K. And the thing is, for a lot of these companies, the cohorts look great, right? They look great at 50K.
Yeah.
And there's something definitely going on from the channel side around this is our sort of internal hypothesis. But a lot of these companies spending 50K a month look fantastic. But the moment they go to 300K a month, things change quite dramatically. And so generally for us, we're looking for, call it 9 to 12 months of solid data at a few $100,000 a month of scale, even 200-300K. Like ideally we'd want to see something at 400 or 500K, 9 months or 12 months of that, and see some consistency. And then, the thing about, like, so that's the bare minimum, right?
Mm-hmm.
That's what we would look at. But the thing that we are very much focused on is the incremental ROAS, right? So if you're spending, 500K a month, but your cohorts are tapping out at 120% ROAS, net ROAS, in 12 months, let's say, that's probably not a great candidate, because generally ROAS curves will degrade as you spend more. That's what we've seen, at least in gaming. And, there's just not a lot of room there, right? But we see plenty of companies that are getting, 180% net ROAS in 12 months, and then keep adding 5-10% ROAS per month every month after that. That's a great candidate for UA financing, where you can say, like, hey, there's a clear path here where you can at least double this spend. And then obviously if the ROAS doesn't degrade too much, you can keep going.
Yes.
I want to flag one thing, which is, it sort of relates to what Pranav said earlier, is that we're always advising companies to think about total dollars, right? What is and this is how we thought about it at MPL, right? It's like think about your net new dollars. Like, can you make net new dollars using this UA financing instrument? Yes or no, right? And if it's a no, then don't use it. Like, it's a clear no-brainer. Don't use it. But if you can, and most of the companies we're talking to, we believe we can, we give them the modeling to also show them. It makes a ton of sense. The other thing is that in gaming, you can track your performance daily, right? Like, you will have a D0 ROAS target or a D1 ROAS target.
Mm-hmm.
So no company is spending 20K a day and then suddenly spending 100K a day. Like, nobody I know, like no UA manager will do that, right? A UA manager is going to spend 20K a day, and then they'll ramp to 22, and then they'll go to 24, and then they'll go to, so you can actually track this in real time. And as long as your early thresholds, your D1, D3, D5, D7, if these ROAS numbers are not degrading too dramatically, you can get that confidence to keep ramping up.
So essentially, when I'm looking at an LTV curve, it's the shape of the curve that matters. So, meaning that typically when you look at an LTV curve, it kind of goes up in the early and then it stalls. And the stalls means that the payers are leaving, or there's some kind of an issue with retention, or maybe the people are just not paying, making repeat purchases, and that goes back to the product side, and you have to fix it. But then in certain games, no matter how expensive the customer acquisition cost might be, like a puzzle game or a forex game, or a casino game, the monetization is so proven, and what happens is as players stick, they just end up paying month over month over month.
Yeah.
And so it's not per se of what is the customer acquisition cost, meaning like, oh, you had a payback in 45 days or in 60 days. Like, that's not as important as the shape of the curve that shows that you are consistently generating revenue from those cohorts over a longer period of time. Because as you said in the beginning, referring to channel strategies and so forth, what can happen is as you begin scaling, the customer acquisition cost is the one that's going to be more flexible. That's going to move along, whether it's going to go down or most likely going to go up. And certainly your payback is pushed back further as you scale. But if you are consistently creating LTV through those cohorts, that doesn't matter as much. It just pushes the payback, but it's going to return more than you've paid in a specific time. Web stores. You've seen what good looks like, but have you seen great? AppCharge is the direct-to-consumer platform backed by the likes of Supercell and built by monetization pros from Moon Active, Playtika, Huge Games, and others. People who know the difference. AppCharge powers over $500 million in transaction a year for top studios, optimizing every detail. Deeply personalized web store offers custom-made design, industry-leading monetization features, in-game payments, SDK, and more. 70% of top grossing games already have a web store, but the ones scaling fastest, they're doing it with AppCharge. Learn more at appcharge.com. Attention app and game developers, are you ready to unlock the secrets behind the world's top performing apps and games? With Sensor Tower, you get the ultimate competitive edge, whether it's breaking into new markets, fine-tuning your UA strategies, or boosting monetization. Dive into data like never before, track global trends across app stores, analyze market-leading in-app purchase and in-app ad strategies, and benchmark your performance with real-time insight. The best part, Sensor Tower doesn't just deliver data, it helps you turn it into action. With intuitive tools and expert analysis, it's everything you need to make smarter, faster decisions. Thousands of app and game studios, from indie creators to global giants, trust Sensor Tower to help them win. So why not you? Start your free trial today at sensortower.com. That is sensortower.com.
Yeah, I think that's right.
One other thing that's worthwhile mentioning, and we've been talking about this in the context, the way Joe framed it around the net new dollars and growth aspects, which I think is the right way to think about it as a growth business, is as you're scaling. The other thing that is important to think about, and this is more relevant for later stage companies that we see very often, again, going along the dimension of how you think about building businesses and think about capital allocation over the long term, is there is a version of the world where you are using your own cash to fund growth. But if somebody else finances that for you, you have excess cash sitting on your balance sheet now that you can do other things with. The first thing to do is keep increasing more growth, which may make sense to a certain point. There'll be different mechanisms to think about that, and based on how you scale your business. But there are many companies that can use that excess cash in many other more productive ways that have much better longer term ROI. That could be initial investments in product engineering, maybe over time buying companies as well. And we have many companies now that are doing buybacks, right? You can just go buy back your shares. Ultimately, going back to the whole capital allocation mindset, the difference between a good and a great entrepreneur is capital allocation. I mean, we at GC have seen this over the last 25 years of history, again and again and again. And ultimately, the capital allocation framework is quite simple, right? You have sources of capital, you have uses of capital. Your uses are COGS, S&M, G&A, R&D. M&A and buybacks. Like these are going to be roughly your main uses. How do you find the right sources of capital to maximize your return on equity while minimizing your risk to equity? And as long as you're within that algorithm throughout as you scale up as a business from the beginning to the end, your outcome is going to be an entirely function of how you think about optimizing that function.
Can you talk about some of the success cases of companies that are known that used UA financing? Like usually what happens is companies don't talk about it. I think I've heard just recently on one like Superplay. I don't know if
Yes.
this is public. Superplay has been already acquired, so that's fine. But I remember somebody saying this is like, thank God we had the UA financing. Like I'm literally quoting that. But apparently they were able to scale quite efficiently to a position where they became an acquisition target.
So we were the backers behind Superplay at the Customer Value Fund, and we worked with them for 5 years. Gilad, I love Gilad, who's the CEO, co-founder. I kind of view him as an honorary co-founder of CVF. He taught us a lot. I learned a lot from him. I still learn a lot from him, but I definitely in the early days learned a lot from him. And it was an incredible journey with them. I had a lot of fun, and like I mentioned, learned a lot. But to your point, that's a company that got bought by Playtika. These numbers are public. I think the specific numbers were like $2 billion. The company raised in the tens of millions of equity dollars. So like if you think of that outcome, and I think the transaction happened like 6 months ago, or roughly speaking, you know what the liquidity environment was 6 months ago. This is a category that's in mobile gaming, which is a very tough category. And you have an outcome where companies raised tens of millions of equity and sold for $2 billion. That's like kind of unheard of. And that happened because of two reasons. The number one is the most obvious thing we've been talking about here, which is, obviously the company saved quite a bit on dilution and all that. And number two, which is the point I alluded to earlier, having a balance sheet to fund growth gave them the ability to invest until a marginal CAC equals marginal LTV, right? They could actually spend to having cohorts, and their cohorts were fantastic. And historically, they were under investing in growth because of the constraints of how folks have thought about financing the business. Not only did that give them the ability to scale very, very quickly, all the excess cash they generated, they reallocated in building new games. So the first game was Dice, the second game was Domino. They were working on game 3 and game 4. So as a business, you could sort of build this incredible business. And in my opinion, a lot of the outcome of this transaction happened in a big, big way, driven by the fact that in some sense, the founder and the company didn't need it to happen. I mean, it's obviously a great outcome, and Playtika is a great company and all that, but like Gilad had the option to compound the business for a long, long time because his balance sheet was sorted. He could fund growth. He could provide liquidity to employees and shareholders because he could go do buybacks. He could invest in new products. And in essence, outcomes are driven when you don't need them. Like, you want to go public when you don't need to. You want to get acquired when you don't need to. You want to go raise when you don't need to. That's just how these outcomes get driven. And you have the most leverage in those outcomes. And so I do think that's a great story of one that that we partner with very closely. And I'm deeply grateful and thankful to Gilad for the partnership with him as well.
Huh. Joe, you work a lot with early stage companies where financing has given them a lift they needed to reach maybe a product market fit and their hit their growth targets. Can you talk about those?
Yeah. So look, all the companies we're working with are private, so there's not that much information that we can share on those businesses. Yes. But today we're working with, actually we just closed a deal last night, so it's I think 13 companies that we've sort of signed up, and I think 8 or 9 that we're actively funding right now, and it'll be 13 by next month. Some of these businesses, we've seen them go from $250K of spend all the way up to the low million of spend, right? So like sort of 1 million-ish, 1.1 million. We have 2 cases like that. We have one company in particular that is a casual game business, actually surprisingly a good amount of ad monetization, but very long-lived cohorts. This is one where I think when we started with them, they were in the low single, like 1 million, and now they're up to like 3 million in terms of their actual monthly spend. So, a couple of good examples there. But unfortunately, I can't name the companies and tell you who they are. And we've only been doing this for 12 months. But I would say, it's certainly not the case where, you take this financing and you can sort of, double or triple. I would say out of the 9 that we're working with, we have 2 examples of that where they're doubling or tripling within months of us working with them. In most cases, it's actually a more steady growth, right? So companies spending say 300-400K, then they ramp to, 500, then they ramp to 600. Like that is most of the companies that we're actually working with. They're not. It's still fairly rare in a game, I would say, where you have the kind of game that can really massively scale, um, like in a short period, right? Most of these guys, as you know, in gaming, right, you need to optimize the product. That creates an LTV gap. Then you want to spend against that. But in gaming, that's going to get copied. 6 months later, you have competitive pressure, and then your CACs increase. Then you have to find another thing, and so it sort of goes in that cycle. But of course, like because of the hit based nature of some of these games, is like you know you will find 10-20% of the companies you're working with who can really massively scale up, but most of them are just sort of the steady growers.
Yeah. How do you avoid becoming a cautionary tale with UA financing? Meaning, like, what's the oversight you have over the way the company uses the financing that they get from you, because you are incurring the risk, the downside of the investment. So
Yeah. So maybe Pranav, you want to go first? I mean, we both have slightly different structures around this,
yeah,
but
Look, the big way we think about it is philosophically, we always want to be on the same side of the table as the company. And so we make sure the company has skin in the game, right? So we will typically fund between, call it 50 to 80% of a company's investment in CAC, but the company's putting up 20 to 50% as well, right? So we want to make sure that the companies has skin in the game. And that I would say solves like 95% of any misalignment that you can have with the company, is making sure the company has some skin in the game as well. Now, but outside of that, the company themselves are internally targeting a certain way of investing in growth. It could be a payback curve, like whether it's D1, D2, D3, or like M0, M1, M2, which is as a percentage of your investment in sales and marketing, how much is being recouped each month, some sort of like a minimum payback curve that they want to spend to. And as long as we're in alignment on what that is, we basically tend to basically make sure the company has skin in the game, and we agree very clearly on what is a good rate of return on cohorts. And as long as we agree on those things, we typically tend to be quite aligned with the company from a risk standpoint. To me, the big thing philosophically that is very, very important when we work with companies is ensuring there's no mismatch of when money is due back to us and when cohorts have paid them. The more of a mismatch there is there, the more risk the company's encumbering. And so this is actually philosophically why we created this product, is to make sure that if we're investing in your growth, we want to make sure that this is risk capital in a way where we only get paid if and when your cohorts pay you. And so those two things are very important: if and when. And in the event that doesn't happen, we are incurring that risk. But the way we manage for that is in the 2 ways that I described to you. And if we feel that we can't take on that risk because we don't think it's good risk, we just pass on the company, right? We just say, hey guys, we need 6 months more of data. Let's actually work with you when you get there. And this is meant to be risk capital for companies, right? So in the event that cohorts don't pan out, for the cohort that we invested in, like the idea is always to make sure we're aligned with the company, is the way we think about it. I don't know, Joe, if you'd add anything else.
yeah. Look, I think I agree with everything that Pranav said. But I would say we try to be a little bit more hands on, because generally the companies that we're working with, if you're talking to a company spending $10 million a month in UA, they have a level of sophistication in their UA team that a company spending $1.5 million just doesn't, right? And so I'd say we are quite hands on in the sense of giving them feedback, with respect to how things, because Pranav and I mean, the way that we're set up is we're very tech enabled, right? As businesses, like we're probably one of the only, like we're the only, I think, like the only funds out there that it's really a technology platform that we do investing out of, right? And so
We call ourselves low frequency traders. You know, you have high frequency
yeah,
trading. We're like
exactly,
low frequency traders.
exactly. And so the thing is, like, we can see, on a daily basis what the ROAS is looking like as a company ramps. I mean, we've had a situation where a company was spending 20K, 30K a day, and then went to 80K for like 4 days. And we saw that, we got alerted, we picked up the phone and called the company, right? And said, hey, what's going on? The like D0 ROAS on these don't look great. Is this going to continue? Like, and sort of got that feedback. So I'd say we are much more hands-on with some of these companies. And then the other thing that we face is, because we are also looking at earlier stage businesses, we also have to factor in the overall credit risk of these businesses, because they are generally less well capitalized than a much larger business. And so of course we look at cohort risk, but we don't ever want to be in a situation where the company has great cohorts but is maybe stretched on in other ways, and it sort of affects the overall credit. So we also pay attention on that, to make sure that if we do participate in these cohorts to perform well, we're still able to the company's still around to kind of benefit from all of that, right? So I would say that's probably the biggest difference. In some cases, we will be even more prescriptive in terms of, okay, this is how much we're comfortable with in terms of month-on-month growth in terms of marketing spend. But yeah, I mean, our dream scenario is to be working with more and more companies that are like what Pranav described, right? Where it's pretty much autopilot, and you can be like, hey, here's the capital. We know you're going to do great. Go for it.
A lot of these, even the later stage companies that are quite sophisticated in the way they do their go to market, right? Like, in some sense, like, we're all the things that Joe described, we're monitoring ourselves. The difference is, we in some sense, Joe has an expertise that he's built specifically in mobile gaming. The thing that's very clear to me is, look, I don't know how to acquire customers, and I don't know how to retain them. That's not the business I'm in. That's the business that the companies that we work with are in. And we provide a balance sheet for them to fund their growth. What we provide them is the infrastructure to show them what is their return on incremental invested capital. And that is something we understand. We understand data. We understand how to price risk. And we think about that all day long. The actual tactics of what is the appropriate way to go acquire customers is not the business that we're in. And so we sort of focus on what we do, because we think the companies are much better than us at acquiring customers and retaining them.
So basically, I mean, let's put it this way. A lot of the time now, companies are looking to get IP or celebrities to support their customer acquisition. That's not part of the financing that you would be getting from you. Like, I can't, Pranav, start taking money from you and signing, Lisa Kudrow's and all the other type of celebrities to advertise.
Right.
But
So
you'll be just supporting the cohorts.
So it actually depends, right? And when I say when it depends is what you're describing is more like brand marketing. So typically brand marketing is not easily attributable, and is often more like a product investment. Now, there will be some cases where it may make sense, like, depending on, like, if you do influencer marketing campaigns, those could be more attributable. So there is a nuance there in general, and depends on the specific nature. Like, we work with many companies that do influencer marketing at scale, and it's very, very successful. And that's actually their main channel of acquiring customers, right? You'll see a lot of the products that we've invested in will be on podcasts. We may be, you may be beneficiaries of our financing, Mishka. I don't know if you run those. I don't know if you do some of that, but either way, the point being, it depends. Ultimately, the goal is we define the definition of customer acquisition cost in alignment with how the company thinks about it. If the company believes that activity will drive ROI, and they think about their cohorts and in the definition that we agree to, then that is fully loaded CAC that we want to be financing. If it is much more unclear that what the ROI is, to us, that's more like a product investment, right? It's much longer term. Perhaps there's value to it. It's just not easily attributable in the near term, and that should be funded in a different manner. That's really what equity capital is designed for.
Got it. And talking about, like, the future, is there, if UA financing is this the beginning? Like, will there be in the future different type of financial products evolving that are helping performance driven companies?
I mean, like, I hope so. I mean, look, I don't know why we've accepted there are only two types of financial products, equity and debt. I mean, like, I think it's an archaic way to think. And not just that, those products were created in a different time. They were created for businesses that had hard assets, right? Like manufacturing companies, and so on and so forth. We've not innovated on how to think about the appropriate capital products for companies that are much more cohorts, right? If you think of the atomic unit of the cohort as an asset, all of a sudden you open up many different potential things that one can be doing. Now, the reality is, I mean, you guys keep me honest here, and I know this is the case for most technology companies, what anywhere from 40 to 80% of the gross profit of a company goes into CAC. It's the biggest use of capital, right? Now, that doesn't mean you can't use cohorts for other uses of capital, but the focus is, the big white space ahead of us is just sales and marketing and customer acquisition costs. But I do think over time, when people start thinking of the cohort as the atomic unit, as an asset, in the same vein, there's this little industry called asset-backed financing, and I joke it's not little, it's gigantic, and it exists because people realize the machine you buy, the consumer loan you originate, the mortgage you originate as a company, these are all assets, and they can be financed in a completely different way. I actually believe the cohort is going to be an asset class, and we are at the very, very beginning of that. I mean, we have barely scratched the surface. I know we're deploying like 9 figures a month and manage 10 figures in AUM, but man, like, just to give you some sense, like, just take the top one cloud 100 companies. And I know this is not relevant for gaming, but it is actually a very easy data point. My conservative estimates say that the top 100 cloud companies, which are private SaaS companies, on average spend 10 million a month on sales and marketing. That's $1 billion a month. That's $12 billion a year. And I'm just talking about SaaS companies that are private, that are 100. I've not talked about public companies, not talked about long tail SaaS, not talked about D2C companies, not talked about consumer subscription apps. We haven't even talked about mobile gaming companies, and mobile gaming is way, way bigger. And then all these categories combined. I mean, I heard a stat, and I don't know if this is true. Like, I think like 10 to 15% of apps on the App Store are mobile games, but they drive like 60, 70% of the revenue, or some ridiculous number like that. I mean, you guys may know the actual stats better than I do.
It's a big number.
Yeah. So from my perspective, treating the cohort as an asset is going to unlock not just an unbelievable set of dimensions for founders on what they can do with their companies. It's actually going to open up a huge source of capital markets. Like, real capital markets are not open to technology companies today. I mean, raising equity capital in like a fund credit line, that's not capital markets. Like, capital markets is when the assets are rated and you have the Japanese insurer that needs a 3% rate of return. How do you get that capital to the next Gilad? Right? That's basically what you want to unlock, right? And that's the mission we're on, right? Is really how we think about it.
Yeah, I mean, I couldn't agree more. Like, I always give this example where, for a traditional business, if you wanted to grow, you built a new factory. And if you want to get lending against that factory, someone will be like, yeah, I'll give you 60% of the value of the factory. You put 40%. And if it doesn't work out, I'll take the factory because I know I can sell everything in there and make 70%, right? And that covers my 60.
And no recourse to the company. It's only to the factory.
And that's been around for 100 years, right? Like, it's been around for a long time. The thing is, in consumer apps, so everything that Pranav has said, like, we agree with, in particular for consumer apps, because in consumer apps, the factory is actually user acquisition spend. And so even this idea, around covenants, right? Like, and Pranav, you've talked about this. I think you wrote an article about how to think about, EBITDA less CAC, right?
Yes. EBITCAC is what we call it.
EBITCAC is what you call it, right? And we say the same thing, which is, look, an EBITDA covenant on a gaming company makes no sense.
Zero sense.
Because you're basically, that's like saying that's the equivalent of an EBITDA minus CAPEX covenant for another company, right? And that wouldn't make any sense. So, there is going to be a paradigm of financing based on ROAS, where the covenant paradigm shifts from EBITDA to ROAS curves or decay curves of existing cohorts. That's where, at least on the, you talked about other products. We are firmly of the view that UA financing is one use case or one interpretation of this, but certainly, like, we are at PVX thinking about, okay, what are other, maybe more traditional looking debt instruments, because they do have a place, but where it's based on a ROAS curve and not based on a like an EBITDA a metric, right? And so, yeah, I think, and to Pranav's point, I think we're at the very early stages of that. right? Like that there are going to be massive financial firms that are going to be built just around ROAS curves.
Like CAC is the new CAPEX, right? And that's why EBITDA should be the new EBITCAC should be the new EBITDA, and that's actually the title of the piece that I had written. And that is a very true statement. It's funny, right? We say these things like, "Oh, technology companies are asset light," but that's an incomplete statement. They're expense heavy, right? What they're doing is, instead of capitalizing the CAC, they're expensing the CAC. So they look asset light, but they look expense heavy. So that's why EBITDA makes no sense. EBITDA is anti-growth. Quite literally, if you spend more on UA, your EBITDA will go down. That's just like, and so why would you create a covenant that's anti-growth? It literally makes no sense.
Yes.
And so the profitability yardstick for these technology companies, and this is, by the way, applicable across all tech, right? If you spend dollars today and you generate lifetime value, you got to be taking the discretionary component of growth and adding that back to earnings. Just like if you look at the history of EBITDA, John Malone created EBITDA because he added the D&A back, right? Which is the depreciation and amortization, because he was investing in cable companies that had a lot of CapEx, and the cash expense, the cash profits of those companies was a lot better, but it looked unprofitable because of the depreciation. So he created D&A. There is an analogy to be drawn here to that doesn't look the exact same. It has different quirks associated with it because it's a very specific thing, but in sense, like, all these companies on a P&L basis just look unprofitable purely because of a peculiarity of accounting. They're fundamentally very, very profitable. And that's just like a pure accounting thing. And look, we see this. We've seen this. I kind of viewed Superplay as profitable throughout. Their P&L may have looked negative, but from our perspective, Superplay through our entire journey was a very profitable company.
Based on cohorts, essentially.
Exactly. Based on cohorts, or if you added UA back. If you add UA back to your P&L, are your existing cohorts of customers enough to fund your non-S&M OPEX? And if that's a true statement, you're fundamentally a profitable company. Like, you just turn off UA and become profitable, right? Like, you're making the discretionary decision to invest in growth. In the old world, the equivalent of that would be, I don't build a new factory, or I don't buy a new machine, right? And if I don't buy a new machine, great. I'm like, back in the day, thankfully, you would capitalize the machine and depreciate it, so your P&L would still look pretty good. But imagine we had this genius idea of expensing machines for manufacturing companies. Any growth manufacturing company would look extremely unprofitable purely because of the accounting, accounting shift, right? It's the same thing that's happening with these companies. And that's unfortunate to see, because then it puts the founder in a tough place. But we believe the unlock is not just at the level of spend, but the enterprise value of these companies. I mean, I really fundamentally believe a lot of these companies are even undervalued, given how massively profitable they can be long term. If they finance themselves well, the return on equity on these companies is spectacular. And don't believe me, just look at Superplay's return on equity, right? A tens of millions raised, $2 billion outcome.
Yeah, I mean, just on that, like, there are a bunch of public companies out there that are truly cohort based that no one understands, because it's not reflected in the P&L.
Because everyone's looking at EBITDA. Everyone's looking at EBITDA and value.
Exactly. And it's the totally wrong metric.
Well, Pranav, I love how energized you are by this. Like you're really, this is your craft. Like, you really feel like.
This is a topic I can talk about forever. I will not stop talking about this. That's why people don't invite me to parties anymore, because this is all I want to talk about.
You'd be like, oh, let me talk about the CAC and the EBITDA. So let's take this home with your advice, both of you. It's like, what would be your advice to founders considering the path of UA financing, especially in gamings and apps?
You can take that first, Joe.
Yeah. Look, I think the key question is, are you at a place where, at least from a a gaming founder perspective, I'll say, is the product actually built, right? Is it at a level of polish where, when you're thinking about your sprints, are you making foundational changes to really fix your sort of LTV, or are these incremental changes, right? Because if you are making foundational changes to the product every sort of 6 weeks or 8 weeks or whatever your sprint cycle is, then what that's going to look like is your curves are going to be all over the place, right? Because if the product is changing meaningfully, every new batch of users that's coming in is getting a different experience, and their LTV is by definition then going to look a little bit different. So are you at a place where the product is actually, basically not like, 95% of the way there? You will continue to make tweaks and change things and run optimizations as you should, but the guts of it is there and it's built. Okay, that's phase one, right? Now, second part is, have you then tested against that? Have you started to spend a bit of money against that? And are you at a level now where you've spent a few $100K a month, you have a track record, you're seeing fairly predictable returns here, and you're generating good incremental ROAS, but also you have the type of business where, even after you're generating, let's say you generate 150% in sort of 9 months, and then it tapers, but is there still sort of continuous month-on-month incremental ROAS here, right? You want to see cohorts that the rate of growth may slow down, but it's still sort of growing month over month. That is a sort of great cohort to finance with UA, because even if CAC increases, because that cohort will just keep generating cash, even if it's 3, 4, 5% ROAS every single month, that means that you have a bit of CAC flexibility. Like if your CACs increase by 50%, you're still going to make money on that cohort. It's just going to take you a little bit longer, right? And so that's sort of what I would say at a high level is the check that I would tell a founder. And if you're there, then I think, if you want to ramp that up, then UA financing is a great option.
Yeah, I mean, look, I was going to actually say a variation of what Joe said, so I'm going to try and say something different now, maybe a bit higher level, which is, look, the ultimate value of your company is going to be driven based on two factors: growth, and that's because growth leads to long-term earnings or free cash flow, and two, the number of outstanding shares you have. Basically, free cash flow per share. Long-term free cash flow per share is the value of your company ultimately. And all these like things that people tell you, EBITDA and all these like metrics, I would encourage people to think about everything from first principles, right? They were designed for a different type of company that may not be the kind of company you're running. And so ultimately, from first principles, how can you design your capital stack and also your business to maximize growth while reducing the number of shares you have outstanding? These are going to be the only two factors that drive the long-term value of your company. And so I would encourage people to think about those two things very deeply from first principles. And if they want to talk about all things capital structure, I know me and Joe like to talk about this all day long.
Totally.
So.
Net new dollars, honestly, like that is the thing. It's just like your job is to make as many net new dollars as you can, as fast as you can, with as little risk as possible.
Correct. And
right?
I would even go ahead and say, if you have a good business, it's your moral imperative to, right?
Yeah, totally.
It's anti-capitalism not to do it.
It's funny, Pranav and I, we catch up pretty much every 2 weeks or so, like, because we're always trading notes. And half of it is basically like therapy sessions where we're like, how come people don't get it? Like it's like a therapy session for us. We're like, oh man, we saw this great company.
It used to be Joe used to provide me therapy. Now I provide Joe therapy as he's been building PVX.
Yeah, because honestly, sometimes you see these companies, and especially me as an operator, I'm like, man, I wish I could just buy your company. Because like I would just buy your company and I would triple your spend tomorrow, because you're just like leaving money on the table. And that's, I think that's the main thing, is that especially in gaming, these windows of opportunity to capture excess LTV don't come. Like, it's so ruthlessly competitive, right? It's not like B2B SaaS where it's much harder for these companies to pivot. Like, if you have a great feature, we're talking to a lot of companies based out of China. Like, the teams there are insane. They're very, very, very good. And like, if you have a great feature, that's going to get copied.
You have it for 3 months, maybe in an AI world for 3 days, maybe.
And so the thing is, if you have this LTV gap, you want to capture that, right? And the way to and that's how you build share. You capture that, you push other people out, you grow the business, and then you tinker, build up more LTV, scale fast and capture that. Like, that's how you can build a billion-dollar business today. Like, that's the playbook in gaming, in my opinion.
Yeah, because in the current market, when you grow, that growth is away from others because the market is not growing at such a high pace. So essentially, by investing in that excess LTV that you have compared to your competition, you're able to gain the market share and the others are losing. And so if you keep that up, then it will be much more expensive for them to catch up to you.
Yes.
And then as you build on the cohorts, because you have the existing cohort base now, you use that excess cash flow to fund and improve your product at a much faster rate. It's a vicious cycle, right? The more cohorts you stack on, the more profitable you become over the long term, right? And you see this across anyone who has CAC and LTV dynamics, you see the same dynamic. The deeper you go in the J curve by investing in growth, the faster you whipsaw out on the other side of the growth trajectory, basically, for these companies. And that gives you a massive advantage as a business.
Got it. So as an operator, basically the takeaways from this is UA financing makes sense when you have enough data, when your product is ready for it. So you are already in the global market. You are investing hundreds of thousands in your customer acquisition, and you have an option to either sell your own equity in order to raise more funds and use those funds to fund your growth further. Or you can do that through UA financing, or you can do a combination of both, which is more likely because UA financing will allow you to grow faster than you're growing right now. And that will probably give you better terms on the equity financing that you can get to further invest back into your product. And then again, raise more equity financing to continue growing, just as Superplay and Candivore and some other companies have been doing throughout the years. But it's not something that you would use very early on. It's not there to essentially take away seed funding or pre-seed funding or anything like that. You need to have the data.
Yes.
You need to have the spend in order to use this tool. But this is for companies to scale and possibly a way for founders to keep more of their equity while increasing the shareholder value.
Yep.
Yeah, absolutely.
100%.
Well,
and actually
gentlemen,
on that, Mishka, on that sort of timing,
yeah.
like we actually wrote a piece on that, sort of the right capital for the right phase. I'll send that to you.
It's a link in the description of this podcast.
Yeah, I'll send that. And also we can send the EBITCAC article as well.
Yeah, I can send that to you as well.
so
I'll email it to you. The CAC is the new CAPEX piece. I'll send it to you.
Yeah.
All right. Well, perfect. Well, thank you so much for educating me and educating the audience. I think this is, I can't say this is exciting. I know you guys are excited. I think this is a fantastic tool to use. I'm not as financial engineer that I'd be tremendously exciting about this, but it's a fantastic tool.
You'd be excited as a founder, trust me.
Yes, yeah. As a founder, as somebody who understands after one round what it means to sell off your equity, I understand that when VCs give you advice or they want to fund you right now, that means that you're in a good position, and there might be other routes to look at the financing. So, again, there's other routes than VCs, and it's an important route, but it's a combination that can be used with other means of financing to grow. So I think that's the one of the takeaways. So awesome. Thank you so much for the insights. And on that note, we're out.
All right.
Thanks, Mishka.
Thank you. Take care,
Bye-bye.
guys. Bye.
Thanks for listening to the full episode. Now, did you know that Deconstructor of Fun isn't just your favorite industry podcast? We're also a bit of a consulting powerhouse. Now, whether you're launching your next hit, scaling your live ops, or vetting your next acquisition, we've got you covered. From market research and go-to-market strategy to live operations tuning and due diligence, our team of experts works with the top names as well as the rising stars of the industry. So if you are building, publishing, or buying, don't do it alone. Do it with us. Email consulting@deconstructoroffun.com and let's build smarter together.